Welcome everyone to another episode of Unpacking Transfer Pricing series, where we aim to demystify complex transfer pricing concepts for our listeners who are interested in transfer pricing. Today, we will broadly discuss Chapter 9, Transfer Pricing Aspects of Business Restructuring, of the OECD Transfer Pricing Guidelines issued in 2022. Our goal today is to give you a high-level understanding of business restructuring from a transfer pricing perspective only. There could be other relevant considerations such as withholding tax, capital gain tax, CFC rules, etc., but we will not touch base upon them. This isn't professional advice, and for specific situations, one should always reach out to actual transfer pricing consultants. A link to a detailed audio-only description is available in the comment section below. So, let's begin. Business restructuring involves reorganizing commercial or financial relations across borders. It includes terminating or renegotiating existing arrangements, converting distributors to limited-risk distributors, transferring intangibles to central entities, centralization of functions, etc. Key issues include applying the arm's-length principle, reallocating profit potential, and managing controlled transactions post-restructuring. The focus of restructuring should be on efficiency, optimization, innovation, and strategic market positioning, but not tax arbitrage. Business restructurings often involve converting distributors and manufacturers into limited-risk entities, reducing their exposure. This includes transforming high-risk distributors into marketers or commissionaires, and high-risk manufacturers into contract or toll manufacturers. Additionally, restructuring may involve transferring intangibles like trademarks to a central intellectual property company, and concentrating functions such as procurement and logistics in regional entities. Basically, their FAR is tweaked. However, opposite is also possible, where a low-risk entity due to maturity slowly becomes a more risk-taking entity. The arm's-length principle under Article 9 of the OECD Model Tax Convention evaluates if business restructuring conditions differ from those between independent enterprises. It requires assessing conditions at each associated enterprise level. Guidance includes determining arm's-length compensation for asset transfers and renegotiations, and applying transfer pricing methods post-restructuring, considering location savings, and comparing pre- and post-restructuring scenarios. Accurate delineation of transactions in business restructurings involves identifying commercial or financial relations between associated enterprises. Examine economic circumstances, business strategies, and synergies. Compare with independent enterprises. Document restructuring transactions, functions, assets, risks, and business reasons. Review contractual terms, identify functions, analyze assets, and assess risks before and after restructuring. In business restructurings, risk analysis is crucial. Identify economically significant risks like inventory, credit, and market risks. Evaluate which party controls these risks and their financial capacity to assume them. Focus on actual conduct over contractual terms, ensuring risks are only transferred if control and capacity are present. This justifies profit reallocation. As discussed, some of the main reason for business restructuring could be centralized control to enhance management of manufacturing, research, and distribution, achieving economies of scale and specialization. Improved efficiency results from streamlined operations. Strategic integration creates group-level synergies, ensuring fair profit reallocation. Document business reasons and expected synergies, providing arm's-length justification. Avoid hindsight in analyses, focusing on anticipated synergies without overemphasis. Assessing accurately delineated transactions involves analyzing functions performed, assets used, and risks assumed by each party before and after restructuring. Evaluate profit potential changes and compare conditions with independent enterprises. Ensure commercial rationality and recognize transactions under the arm's-length principle, as guided by the OECD to determine if restructuring is justified for each entity. Technically, all things considered, no entity should be worse off than before. Compensation for restructuring must adhere to the arm's-length principle, ensuring conditions align with those between independent enterprises. Evaluate transfers of intangibles or valuable assets, and assess termination or renegotiation of arrangements. Key considerations include comparing conditions with independent transactions, analyzing functions, assets, and risks, and identifying any deviations. For instance, a distributor's risk shift to a manufacturer requires careful evaluation. In business restructuring, cross-border transfers of value between associated enterprises require arm's-length evaluation. Tangible assets like equipment and real estate are valued by market price. Intangible assets, such as trademarks, are valued on profit potential. Business operations value depends on functions and risks. Compensation aligns with independent enterprise conditions, using comparable transactions or independent valuation. Business restructurings often require assessing compensation for terminated or renegotiated arrangements. The arm's-length principle ensures conditions mirror those between independent enterprises. Evaluate profit potential reallocation, contractual terms, and commercial reasons. Analyze if restructuring centralizes operations and compare with uncontrolled transactions to determine fair compensation. Each entity's perspective is crucial, not just the group's strategy. Valuation methodologies are crucial in transfer pricing. The comparable uncontrolled price method compares similar transactions, while discounted cash flow values assets based on future cash flows. The residual profit split method allocates profits based on contributions. Each method has its pros and cons, such as complexity or data requirements, and should be chosen based on specific transaction characteristics. This slide is prepared based on market knowledge and not specifically outlines in OECD. Compensation for restructuring is not always necessary. The arm's-length principle ensures no compensation is needed for reduced future profit expectations if no commercially valuable rights are lost. Restructuring aligns with group synergies without altering the entity's functional profile. The local entity remains compensated at arm's length, with no significant profitability change, driven by business reasons without a value shift. Business restructuring begins with setting targets and analyzing revenue and margins. It involves assessing business needs, stakeholder involvement, and financial capacity. Contracts and operations are reviewed, including novation and legal due diligence. Pre-stage involves brainstorming and need analysis, while post-stage focuses on results. This roadmap ensures logical and reasoned restructuring. This is a generic representation of a typical restructuring process, not something mentioned in the OECD TP Guidelines. Post-restructuring arrangements require careful consideration of risk allocation and financial capacity. Accurate pricing under the arm's-length principle is essential. Methods like comparable uncontrolled price, profit split, and cost plus are applied based on transaction characteristics. Identifying reliable comparables and conducting functional and risk analyses are crucial for selecting the appropriate transfer pricing method, something we have learned multiple times over this series. Analyzing pre- and post-restructuring scenarios reveals shifts in functions, assets, and risks. For instance, Company A, after relocating manufacturing to Country B, retains brand rights and design functions. Despite changes, it continues similar roles, suggesting a funding arrangement rather than centralizing intangible management. Article 9 highlights challenges in valuing transferred functions, assets, and risks. This analysis is must for documentation, since this is what will definitely be asked by tax authorities if picked up for scrutiny. As per the example set out in this slide, analyzing pre- and post-restructuring involves examining decision-making shifts, key personnel relocations, and changes in contractual liabilities. Assess the source of financing, the status of various functions, and the handling of intangible and tangible assets. Evaluate who assumes financial and operational risks, distinguishing between full-fledged and contract manufacturers beyond mere contractual obligations. This is not an exhaustive list, but just as an example to drive home the point. Location savings occur when a multinational enterprise relocates to a lower-cost area. Key factors include functions, risks, and assets. For example, a clothing manufacturer moving from country A to B should attribute savings based on brand value and competitive position. Similarly, engineering services subcontracting to a lower-wage country Y should consider service specialization and competitive advantages. Restructuring compensation and post-restructuring remuneration are interconnected. Parties might offset upfront compensation for future benefits. Tax administrations should assess the entire arrangement, considering arm's-length evaluations. For instance, outsourcing involves transacting with an associated enterprise post-disposal, while manufacturing and distribution require evaluating compensation for both restructuring and subsequent transactions. Key challenges in business restructuring include justifying the rationale, valuing the going concern, and relocating key decision-makers with a functional analysis. It's crucial to document decision-making processes, financial projections, and ensure compensation aligns with arm's-length principles. Addressing double taxation risks preemptively is essential to avoid future disputes. That's all for this episode of Unpacking Transfer Pricing. Remember to seek expert advice when taking business decisions. Do join us for our last and 10th episode where we delve into fascinating world of financial transaction. Until then, keep learning.